Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. We are tracking President Trump's big meeting at the White House. You're looking at live images there of Trump with Ukrainian President Zelensky and European leaders. Conversations center on Ukraine's position as they seek an end to the war with Russia. Trump says substantial progress is being made on peace. The president says he's going to call Russian President Vladimir Putin after the meetings today. He hopes to arrange a trilateral meeting with Ukraine and Russia. Trump met with Putin in Alaska on Friday. Zelensky's last Oval Office meeting back in February, remember, went sideways and ended abruptly as President Trump accused Zelensky of not being grateful enough for U.S. support in the war. It's just an hour to go now until the closing bell, and stocks just slightly lower as traders await a big week of retail earnings and Fed Chair Powell's big speech out of Jackson Hole Friday. Right now, just look at the popular averages. Dow's down about 40 points. The S&P 500 and the NASDAQ both flat. Russell 2000, your small caps, up about 0.4%. Let's welcome in now Washington Crossing Advisors Senior Portfolio Manager Chad Morganlander, along with Yahoo Finance's Jared Blickery and Inez Ferre, joining us now to break down all the headlines. Jared, kicking it out off to you on today's trading action so far.
Thank you, Josh. We got a mixed board here. We're not seeing a whole lot of action, at least at the index level, and we'll go into some sectors in a minute. Dow Jones off a whopping 40 points or 9 basis points there. The NASDAQ up just barely 9 points or 4 basis points, and the S&P 500 exactly flat, just a little bit to the downside, less than a point. And there's not a whole lot going on in the bond market. Here's a 10-year T-note yield. That is up 1 basis point to 4.34%. The 30-year getting a little bit closer to that 5% threshold, but right now at 4.94%. Nothing to write home about. So I'm going to skip over to the sector action. We can see some of the sectors are going up, some are going down. That's what's creating this very low volatility at the index level, and that's kind of the nature of rotation. But in consumer discretionary today, that is what we are seeing up the most. That's up almost 0.5%. Then we have industrials, tech, and financials, all of those in the green here. What's not working to the downside, we have real estate down 0.7%, followed by energy, materials, and utilities. All of those down by 5% or 0.5% or more. And here's the NASDAQ 100. You can see not a lot of love in the mega caps arena. We got NVIDIA, that is the largest stock, up 1%, and Tesla's up over 1.5%, but Meta's down 2%, Microsoft, Apple, Alphabet, each of those down less than 1%. So is Broadcom for that matter. And let's take a quick look inside tech. We see a split board here, some winners, some losers. Aside from NVIDIA, probably seeing more green than red. KLA, Applied Materials, ARM, Micron, each of those up more than 1%. And if we look inside another industry group within tech, we also see a split board here. ServiceNow up 2%, but meanwhile we see Palo Alto down about 0.5%, IBM just about even, EA down about 3% there. And let's take a look inside some of our leaders and really kind of flesh out where we're seeing the hot money flows. MJ, that is a cannabis ETF I like to track, along with solar. Those are two that are revolving around Trump policy. We've seen some bullish action the previous days, maybe a continuation of that. I mentioned consumer discretionary, while XRT is a retail ETF. Also working today is China, oil. We have emerging markets, IPOs, and small caps. To the downside, we have Korean stocks down about 0.75%. That's a proxy for the chip sector, and also crypto. I'll leave it here because this is a pretty red board. We're seeing Solana, Dogecoin, and Cardano all down about 3-4% here. I'll send it back to you.
All right, let's head to Inez Ferre now with the latest in the oil market as investors turning their attention to Donald Trump's meeting with Ukrainian leader Zelensky. Inez.
Yeah, Josh. And if you take a look at the market reaction, you are seeing that oil edged higher, about 1% for both WTI and Brent crude after that Zelensky-Trump meeting. And also after Friday's meeting between Trump and Putin, you are seeing a tight trading range. In fact, over the last 5 days, oil is basically flat. That is basically indicating that traders don't see a ceasefire anytime very soon because you have that tight trading range range over the past month. You're seeing that oil has declined. A ceasefire would free up oil, although it's debatable. Some on Wall Street are saying that Russia really goes by what OPEC Plus is determining for the quotas. But nevertheless, if you have a ceasefire, then that presumably would free up more oil. And also, you've had Trump backing away from secondary tariffs on China, for example, for purchasing Russian oil. So all of that put together, and you see that tight trading range. But nevertheless, we did see oil going higher today. The big focus, though, for traders is OPEC Plus, what they're doing with their supply, and also seasonal demand, which is lower going into the fall. You still have Wall Street that is anticipating that Brent is going to go lower from these levels into the fourth quarter of this year and into the 50s, upper 50s for 2026, Josh.
All right, and Chad, your thoughts. I want to get you in as well on today's trade and just the week ahead here, Chad.
So it's just a seasonally listless trading day today. Volumes are pretty much at their norm. And then looking forward this week, you're going to look at the big box retailers, Walmart, the Home Depots, the TJ Maxx's. That's going to tell you the health of the consumer on a broad basis. And then look no further as the Jackson Hole meeting. That's going to be the big one. We think that the Federal Reserve is going to tilt to a modest signal that they're willing to lower rates maybe once, perhaps twice by the end of the year.
All right, Chad, we're going to talk a lot more about Powell coming right up. Thank you, everyone. Well, President Trump meeting with Ukrainian President Zelensky and European leaders to discuss a possible end to the Russian-Ukraine war. Trump says the next step is a trilateral meeting with Ukraine and Russia. What should investors have their eyes on out of these meetings? Well, join me now. We have Henrietta Treyz, Beta Partners Managing Partner and Director of Economic Policy. Henrietta, always great to see you. So you are watching Trump and Zelensky. You're watching, you're listening, Henrietta. What are your high-level thoughts of what you've heard so far? It's certainly, so far, Henrietta, it sounds a lot different than the last time these two met.
Certainly different than the last time. I understand there was quite a bit of briefing from the European leaders to Zelensky to try to help him navigate the meetings in the Oval Office in a little bit different way than he did earlier this year, which obviously ended in disaster, nothing short of disaster. So a lot of coordination. I think what investors are waiting for as we come out of these meetings now is indications from the Europeans that they have some additional thoughts to offer, some additional ideas to throw at this negotiation to make a trilateral, which obviously President Trump wants, actually yield something beyond just, hey, let's all try to get in a room. So a lot of the onus and a lot of that hope in DC circles right now is that the EU will have a louder voice and offer some constructive guidance to steer this in a direction that we haven't gone down before, which is to say an actual path to a ceasefire. The president's talking about a NATO-like force, military dynamic. There is not a NATO-like anything. There's either NATO or not, or the U.S. So I think that the European leaders are really where a lot of DC eyes are on right now, hoping that they can be additive to this conversation.
You know, Trump is saying, Henrietta, that he's given Putin a call after these meetings. If you got that meeting between Trump and Putin and Zelensky, would that be considered, you know, a win from these meetings, an accomplishment? Would that give investors some comfort?
I think if it can be scheduled in the near term with a concrete date, investors would like that. Here's why. We're all eyes on the India tariffs, the secondary tariffs that the president has created as sort of a tether to get some sort of movement out of Russia and Putin, and then also Zelensky. So when we think about oil and gas prices, which obviously you were just covering in such great detail, what we really want to see is, will the additional 25% tariffs on India go into effect? That will happen next week. So they want to see some sort of speed, clear time horizons, and indication that there is progress being made, not just these talks. The thorny details are going to take weeks, if not months, to hammer out from there. But really, our eyes are on the India tariffs right now.
There's also, Henrietta, there was a lot talked about this security guarantee for Ukraine. Henrietta, the idea seems to be, well, Ukraine would, I guess, give up some of this territory in exchange for security. You know, it was interesting and certainly got some attention. Trump didn't seem to flat out rule out the possibility of American military participation there in some degree. What did you make of that?
There's a couple things here. Without getting too distracted, we have to remember that Congress has a tremendous amount of say here. It's going to require 60 votes to keep the government open into October. And these congressmen and senators have a tremendous amount of support for Ukraine. So when they get back into session in early September, one of the first things they're going to say is, have any of these sanctions against India actually gone into effect? You haven't put them on against China, which is another gigantic buyer of Russian oil. What have you actually done? And they're in a position to extract concessions from the president and force forward progress. So we have about 2 weeks worth of time right now before Congress gets back. And when they do, we know that there are a number of Ukraine and Russia hawks in the United States Senate. 85 of them, for example, specifically have endorsed a sanctions package of 500% on anybody doing business with Russia. So the president is under a time constraint here, because when lawmakers get back in session in September, they're going to demand forward progress here. So I think this is a pivotal 2 weeks for the White House specifically to act with autonomy, without oversight.
Henry, the last time they met, Trump, of course, said to Zelensky, you don't have the cards, right? Is that in part, do you think, why Zelensky showed up this time with these European leaders, these high-profile leaders? Was he suggesting, trying to signal there that he does have cards, that he does have broad support?
It's almost like he's trying to convey that it's not Ukraine that is exclusively at risk here. You have other nations on the Russian border in the near vicinity, Poland, obviously, and other NATO allies that are very clearly telegraphing right now, this is not where it ends if Putin doesn't get stopped now. This is in our best interest. You don't want to have war in additional nations. You don't want to have further deaths. You don't want to spend more on American defense going overseas to fight this war. You better stop it now. It is the least costly alternative. I've noticed a lot of that sentiment going around. This is actually the cheapest option to end it now. I think that's definitely something that the Ukraine and the European leaders are trying to convey to the president right now. Do it early and end it so that it doesn't escalate in the future and get more and more expensive as the months wear on.
Henrietta, always great to have you on the show. Thanks so much for your time.
Thanks for having me.
One key event investors looking ahead to this week, the Fed's annual economic policy symposium, Jackson Hole, Wyoming. Fed watchers looking for more color on the central bank's policy framework. Chad, what are you looking for and listening for at this conference?
So this is a real tough one for Powell. He has to really thread the needle quite delicately.
How does he do it, Chad?
How does he do it? He tips his hat that the economy is slowing. Look at the jobs numbers and the revisions. At the same time, that PPI came out pretty hot. So he's going to, we believe, signal that he will be reducing rates by the end of the year. 1 or 2 times, September or October, who knows? That's the big question mark. But also, you're going to get all these other Fed governors that are going to be speaking in front of cameras, and they're going to be extremely, extremely dovish. So overall, we think that the Fed should be lowering rates, that the housing market is really stuck in the mud, the economy is stuck in the mud. And if it really wasn't for fiscal stimulus, then this economy would be marginally lower on the GDP numbers.
If he decides, Chad, to thread the needle the way you're suggesting he might, I'm curious how you think the market responds to that.
The market's going to perhaps sell off a bit because they're not going to get a guarantee of 2 or 3 rate cuts.
Yeah.
But overall,
well, they're betting on that cut, Chad, next month.
I know they are, and that may be a little bit of a disappointment.
Right.
But overall, we think that by October, November, he's going to cut rates. It just may not be the 50 basis point, home run that everyone was hoping.
Did you agree when you heard Treasury Secretary Besson say, listen, I think they should be doing 50? You thought what?
I thought that he's just talking up, trying to make Donald Trump happy. He knows that the Fed's in a tough situation. First of all, financial conditions are ridiculously loose right now. The credit spreads on bonds are historically tight over a 30-year period. Equity risk premium is historically low. PE multiples on the market cap weighted index are pretty high, not .com high, but pretty high. So, you really, even though they're tough on right now on how the rate structure is with the Federal Reserve, meaning the Fed should be lowering rates, it's not an emergency. It's not a 5-alarm fire at this point.
Yeah, if they didn't cut in September, though, what do you think the reaction in the White House would be?
Oh, they'll flip out. You'll see, the Twitter,
Yeah.
the Twitter
That's the
fear.
technical.
That's the financial. But at the end of the day, maybe the market will trade off 2 or 3%.
Yeah.
It's not going to be a downward spiral where you're going to get financial conditions that are going to tighten immediately.
Yeah.
They're going to be lowering interest rates. The market knows it, and they're kind of you're going to hear the first signal of it this weekend.
All right, well, for more on what the markets can expect from Fed Chair Powell's remarks at the central bank's annual economic policy symposium, let's bring in now Julia Herman, global market strategist at New York Life Investment. Julia, great to see you. So we were just talking there with Chad about the Jay Powell, Jackson Hole this week. The team at Evercore said something interesting. I'll run it by you, Julia. They said Powell is likely to indirectly signal a rate cut of 25 basis points. All right. Then they said October and or December cuts will be data dependent, they say. And they say if you get that sort of balanced view, that they say could catalyze a near-term 7 to 15% pullback into October. What do you make of that?
Well, I think it's possible that the Fed does deliver the 25 basis point cut in September. But at this point, I think every single one of those 25 basis points is about signaling more than anything. I don't see much of anything that supports a protracted easing cycle in this case. And
do you think, are you saying September's one and done?
Not necessarily one and done, but one and then maybe sporadic from here. Now, there have been some very serious investor conversations I've been having, including amongst those who want to buy a home, those who want to see better credit creation, those who might want to see a little bit of a valuation bump in their asset class. But all those conversations would require maybe several hundred basis points worth of easing and not the 25 basis point cut we're discussing today.
Do you think, Julie, the market needs a cut to move higher? Because we've had some CIO strategists on the show who say no, because in part they'll say what's been driving the market higher. It's tech, it's AI, it's not rate sensitive.
I don't think it needs another cut to move higher, precisely because when you have equity markets that are right near their record highs, when you have corporate credit spreads right at their historic tights, it's almost impossible to argue that policy is too restrictive, right? So I think that we've seen a clear, less cyclical, if not fully acyclical driver of the market in artificial intelligence. And there's no reason that needs to be supported by one cut versus another at this point in the cycle.
Chad, bring you in here. What's your answer to that question, whether the market needs a cut to move higher?
It doesn't need a cut. What it needs is a kick up of GDP growth that will translate into broader economic and earnings growth for the rest of the 200.
Would the market get that?
Yeah, the market could get to higher highs, and what we're favoring is the equally weighted index. I mean, one has to keep in mind when we talk about the market, the S&P 500, about 20 stocks represent 50% of the S&P 500. What about the other 480 stocks? And those multiples are somewhat less overvalued, we should say. There seems of opportunity there, and we can get there.
Julia, I want to bring it back to earnings. We've got names after the bell today. We got a mess of retailers this week. What have been your sort of just high-level thoughts from the earnings season?
Yeah, well, I mean, when we look at the valuation backdrop, which is of course supported by still pretty strong earnings growth, double-digit earnings growth is nothing to sneeze at. We're looking at an environment where we have really bad consumer sentiment that's not necessarily aligning with corporate earnings. So moving forward, what I think I'm looking for more than anything is preference for U.S. assets, in U.S. assets specifically over international or European assets.
You don't like the international?
Not necessarily.
I have so many people banging the table on this show on international. I should be looking to Europe.
Well, we need to remember where the juice came from in that trade, which was a weaker dollar. And we got Treasury data last Friday that showed us that investors are not running for the exits when it comes to U.S. assets. They're actually pouring money into U.S. equities. So we saw at one point a 30% pace of international equity outperformance over the US in the first quarter. That trade has now faded, and European equities and global equities are now trailing US equities. So we expect that trend to continue to slow. But it does come back, I think, exactly to your question about earnings growth. It's primarily coming out of the US, and it's really, really hard to buck the large cap US trend right now.
Chad, do you like any opportunities overseas, or would you stay home?
We are a little modestly overweight overseas at this point in time. We think that it could be a continuation of a reduction of the dollar. We're not looking for a 10 or 15% pullback, but perhaps 3 to 5%. There's a lot of fiscal stimulus. that we have not seen in many years. We think that that's a big tailwind for the European trade. Also, those indices have a large allocation towards financials, and if the yield curve continues to steepen, then that will bode well for that industry, the financials, and for those for that group.
Julia, one theme we were all watching closely during earnings season was that mega AI trade and trend. I mean, I think we all looked through those earnings reports, you listened to the calls. It sounds intact, but what do you think?
So in my view, AI is the investment megatrend that's been delivering instant gratification on a 10, 20, 30, 50-year theme. And I think that thesis is absolutely intact. Sometimes for me as a holistic strategist, it's less about any one earnings report, and it's more about the fact that we have seen exponential paces of investment in things like data centers or in the construction of manufacturing activity in computer and electronic sectors. This is happening as we speak, and the fact that these companies are able to deploy so much CapEx, including in the less direct parts of the supply chain and things like shoring up their access to energy and materials to run their data centers, and the market understands that thesis and they're willing to accept it, I think that's a critical part of the AI story right now.
Julia, I was talking to a CIO last week on the show, and I asked him, is it too simplistic to just watch the Mag 7? And as long as I listen to those CEOs, as long as Zuck and Nadella and Cook, as long as they tell me everything seems solid and business looks strong, I should just stay along the market. And I said, is that too simple? He said, not really. But what do you think?
Well, look, valuation is still a problem for this market, and nowhere is that conversation more pertinent than in large cap tech in the United States. But when the Fed is biased toward easing, in not a recessionary economy and an economy that's slowing, sure, you're going to be really hard pressed to find a clear-cut value argument anywhere in any sector that you want to be in at this point in the cycle.
Julia, always great to see you, especially on set. Thank you. All right, we are just getting started here on market domination. Coming right up, the Trump administration reportedly considering taking a 10% stake in Intel. Our tech editor has more details there. And another edition of Goodbye or Goodbye. Our guest reveals one stock to consider in your portfolio and one to avoid. Plus, consumer staples. Could this sector prove resilient amid continued uncertainty? All that and a whole lot more when we return. The Trump administration discussing taking a 10% stake in Intel. According to a Bloomberg report, shares of Intel are falling ahead of the close. And joining me now is our tech editor, Dan Howley. Dan, fill us in.
Yeah, Josh, this report follows an earlier report about the potential for the Trump administration to take a stake in the ailing chip maker. Now, there's discussion on whether this could be used from the CHIPS Act money, using that as the money that was awarded as possibly the part of the stake to get the U.S. government kind of that access to Intel. It would make it obviously a massive shareholder in the company. And it's all kind of a part of this ongoing turnaround effort that Intel is in. President Trump had previously called for Lip-Bu Tan to step down because of his investments in China. Then after the meeting that they had last Monday said, everything's kind of hunky-dory now. And so it really is this ongoing back and forth. But the turnaround story for Intel, it just really hasn't been what I think anybody wanted it to be, including Intel itself. The board ousted former CEO Pat Gelsinger over the turnaround, which included building out factories around the world and building out the equipment they would need for that. Then Lip-Bu Tan comes in his last earnings, basically saying that they're going to stop construction of some factories and slow the building of that mega complex that they're putting together in Ohio. And so, they're struggling with their own chip designs to get them up to snuff. They're struggling to bring in customers for their kind of third-party foundry business that they have. And we just have to see what a takeover or a stake by the U.S. government would entail, and if that makes the company change its plans further. If it allows it to then gives it some of the leeway that it would need to ensure that foundry business continues to operate. Obviously, Intel strategically important for the U.S. So there's still a lot of questions up in the air, including whether or not this actually gets done. At this point, it's still just a report. We haven't heard anything from the White House. Intel had previously released a statement about it, just saying that they wouldn't have any comment on a particular acquisition or stake that the company would see from the government last week. So, it's all still very fluid at this point.
Do you think, Dan, this is one and done? This is just an Intel story? Or do you think, hey, maybe this becomes a model for others? Because there were other names on the receiving end of that CHIPS Act.
Yeah, I think it's more like a one and done, just because, like I said, how strategically important Intel is for the U.S. It's its most advanced domestic manufacturer, has its own manufacturing capabilities in the country. Obviously, we've seen other companies, including TSMC, Samsung, start to build up newer factories here as well as part of the CHIPS Act, and then the kind of push for onshoring that the government has been undergoing over the past few years. But TSMC doing well, Samsung, doing better than Intel for sure. And so I think it would just be an Intel thing at this point. Don't forget there's other manufacturers in the U.S., Global Foundries, Texas Instruments, things along those lines. But Intel is kind of the marquee. And I think it's just a matter of the U.S. ensuring that the name is still there and its capabilities are still available for use.
Dan, thank you. Appreciate it. Crypto continues to pull back from last week's record highs. And for more on the latest action, let's look to Yahoo Finance's Inez Ferre. Inez.
Yeah, Josh, some profit taking place right now. As you saw, Bitcoin is trading just above $116,000 per token. You've also seen Ether that has come down also to about 4,360. And this is after Bitcoin last Thursday touched an all-time high above 123,500. Also, Ether has been on a massive rally this year as well. Look, you've had market expectations of a Fed rate cut. Now that's iffy as to whether it's going to be 50 basis points or more likely a 25 basis point cut, and some profit taking place. So the market will be taking a look at what Jerome Powell says in Jackson Hole. And one trader has said that if Powell gives a sort of wait and see approach, you could see a consolidation for Bitcoin around the 115,000 to 120,000 level. I do want to mention also that we also had a filing to go public last Friday from crypto exchange Gemini. This is a company that was founded in 2014 by the billionaire twins Winklevoss, Cameron and Tyler. So the terms of the IPO have not been released, but looking at their balance sheet, they reported a net loss of $280 million for the 6 months, which ended on June 30th, and that was on revenue of $69 million. But this just sort of highlights the enthusiasm around crypto and anything that's crypto related when it comes to companies that are going public in the IPO market.
Thank you, Inez. Appreciate it.
Thank you.
Now time for some of today's trending tickers. We're taking a look at GoodRx, Meta, and CVS. Let's start with GoodRx. Those shares surging as the company strikes a deal with Novo Nordisk to offer lower prices on GLP-1 drugs. So this one, Chad, basically Novo Nordisk says, okay, we're going to cut the cost of Ozempic for cash-paying patients. It's going to now for $499 a month, partnering with GoodRx. Its CEO, GoodRx, telling Bloomberg the partnership with Novo makes it easier for patients to get a more affordable version. Says we are the #1 branded marketplace to see cash pricing on brands and generics. She goes on to say, so for that reason, we already have the millions of consumers searching for these types of products. What do you make of it?
So it bodes well for the consumer, and temporarily it'll bode well for GoodRx. The question is, with GoodRx, does it have a durable business model that a well-funded competitor can't just come out and really compress their margins and also stunt their growth? So this company, from our perspective, is more of a lower quality company. It doesn't have as large of a defensible moat. It should perhaps be put into a private equity fund or a actual competitor that's much larger and well-funded.
All right, I want to get your thoughts on this one too. Take a look at Meta as the company plans for the 4th restructuring of its artificial intelligence efforts. That's according to a report from The Information. So this one, Chad, basically, all right, so Meta planning the fourth restructuring of its AI efforts. That's in 6 months. This is the information citing sources. Meta's new AI organization, Chad. So we got Meta Superintelligence Labs. That's expected, per this report, to be divided into 4 groups. One of the groups, temporarily called TBD Labs, expected to have 6 leads. What's interesting is all recently hired from outside Meta. Meta, of course, Zuck has been on this hiring spree, successfully poaching pretty big names from his rivals.
Absolutely. They're going to totally get it wrong until they get it right, and they're going to spend billions upon billions of dollars to try to get it right. But the reality is that they do have competitors. We're going to be talking about a company a little later, not going to mention it yet, and also Microsoft, that are both well-funded. So overall, this is a good business model. The valuation may be a bit toppy, high-quality company. For someone that owns it, we would continue to own it. For someone that doesn't own it, we would wait for a pullback. But again, it's a durable business model.
Finally, CVS getting a lift at Guggenheim. UBS upgrades the drugstore chain to a buy. Analyst says this follows 2 strong consecutive quarters of execution. Early signs of the healthcare benefits segment, they say those fixes are on track. Company has strong growth prospects, they argue. Compelling valuation. The target goes to 79 on this one. What do you make of it?
Compelling valuation if you're looking at it from a PE multiple perspective. If you include the debt, the aggregate debt, then the multiple can go to 20. So they have to get it perfectly right. It is more of a lower quality company, due in part because of the leverage. And also, one must keep in mind that CVS is not growing at leaps or bounds. They're trying to right fit that side of the business. So overall, we think that there are better seams of opportunity within the healthcare market. But one has to continue to be somewhat patient because you're still going to continue to still see the MLR issue, which is going to hamper their growth and their earnings temporarily for the next 3 to 6 months.
All right. Well, coming up, goodbye or goodbye. One stock to consider investing in and one stock to avoid. That's coming up next. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Washington Crossing Advisors Senior Portfolio Manager Chad Morganlander. Chad, great to see you. Let's start with what you think is a buy. And this name is Alphabet. Analysts, I got smart analysts on the show, Chad, and they'll say, listen, they like this name. They'll say advertising's resilient. They'll talk about the cloud momentum. They'll say healthy margins. But let's see the reasons you think it's a buy. We'll start with bullet point number 1. You say strongly positioned for future growth.
Without a doubt, we think that the search property is going to be layered with AI, that's going to continue to grow and be resilient. Also, you have Waymo, which obviously is dominating the autonomous driving market. And then they have DeepMind, which is the artificial intelligence backbone, which is really going to run the entire company going forward.
Bullet point number 2, you say Alphabet's a buy because search should continue to be resilient.
Yes, I mean, all you really need to have happen here is search to grow by 8 to 12% year over year to actually move the stock price higher. The overriding concern is that there's going to be more competition, and that is one of the reasons for the multiple being so compressed.
Final reason you say Alphabet's a buy, power from Waymo, YouTube, DeepMind.
Yeah, okay, so you have to understand that we've got ourselves in a situation where Tesla is valued at over $1 trillion because of Tesla's big push towards autonomy as well as robotics. Mind you, the Alphabet is actually doing it, and they're successful at doing it at this point. So we think that the valuation for Alphabet is artificially compressed. Also, when it comes to DeepMind, they play the long end of this long ball kind of game here, where you have ChatGPT that perhaps is moving quick and fast. They're trying to break things. We think that the DeepMind team is being more pragmatic about it, that they're going to embed all of their stuff into their services, and it's over the long run going to keep this company much more competitive with the likes of Microsoft as well as with Tesla.
Now, those are all the reasons to buy, Chad. Before people buy, all pile in, right? Let's talk about some risks you think they should consider?
Right. Obviously, ChatGPT has been the belle of the ball, and they continue to be that. We think, though, that if ChatGPT was to get into search, that would be the major risk, the tail risk that we're talking about here. And then when it comes to regulatory issues, we have in August, which we're in today, a judge that's going to come out and try to, perhaps bad news, dismantle their browser or whatnot. We think that that's going to be an extended kind of argument that's going to be held up in the courts for a couple of years. So we don't generally think that that's going to ruin their business model as of yet. And then, of course, the whole thing about not being able to convert their IP to durable growth. Back in the 90s, I was acutely aware you had companies like IBM, like Lucent Technologies. They had the best internal labs. They were not able to monetize all of that knowledge into real workable products.
All right, so we're going to buy Alphabet. Let's get to one you would avoid. You would avoid Robinhood. Now this one, Chad, most on the street, they still like this name. It has had, look at the chart. It has had, it's up 200% this year. It's up 460% over the past 12 months. Let's go over the reasons you would avoid it. One, company's valuation, silly, Chad. It's silly.
Market cap is $100 billion. We've experienced this before back in the 90s with E-Trade and Ameritrade. That doesn't mean, and I don't want to take away that the company isn't a well-run company, but what's going on here is that they're getting a tailwind from not only day trading because of the retail investor, kudos to them, but also the crypto surge. Eventually, that's going to decelerate. Hence the reason why we're somewhat more concerned about the valuation. Goldman Sachs, market cap's 250 to 225 billion. This is 100 billion because of the gamification.
Second reason you would avoid this one, no wide moat relating to competition.
Yeah, the reality is that Goldman Sachs or Morgan Stanley or others like Charles Schwab could just price them out. This is not as if they just invented another GLP-1 drug. This is a very competitive market environment. And also, one has to keep in mind, the stock market goes up and then goes down because of credit spreads and malfunctioning markets from time to time. At a $100 billion market cap, you're really in nosebleed territories.
Third reason you wouldn't go near this one. Let's look at sensitivity to retail investor base.
Yeah, look, I'm not taking away the retail investor into the marketplace, and I don't think that the retail investor is the silly money at all. That's not the case. I think they're quite wise. It's just that at one point, when you have credit spreads that are so historically tight and equity risk premiums that are so historically low, and a crowding of the market, it's just a very dangerous spot for the retail investor. And we believe that that can perhaps, like the seasons, come in and out. So we would just be somewhat more circumspect about this company.
Let's end here. How could you be wrong, Chad, on Robinhood?
Well, how could I be wrong? Well, valuations have to come down considerably for us to be more mindful about buying it. I would have to say that perhaps there's a continual surge of equity enthusiasm. I don't think we're right now at the top of the market in regard to what it was like in 1999. Maybe we're 24 months away from it. Remember, the S&P got to 33 times. We're at 24 times now. So there could be some more speculative fervor before there's a reversal of that.
All right. Buy Alphabet, avoid Robinhood. Thank you, Chad. Thank you all for watching. Goodbye or goodbye. More market domination coming right up. Retail is in focus this week as a number of big box retailers reporting earnings. Yahoo Finance's Julie Hyman sat down with Storch Advisors CEO Jerry Storch to take a look at the state of the retail sector.
When these earnings reports come out, we're going to get two types of information. We get, of course, the rearward-looking information. How did they do in the second quarter of the year for retailers, which is May, June, and July? And we already know that was pretty benign. The consumer did fine. And the latest retail sales report, which covers July, the latest month in that series, showed a retail sales gain of 3.9%, considerably above the inflation rate. So the consumer is acting like they're in a pretty healthy place, despite all the uncertainty, despite all the worries about tariffs and inflation and other concerns. So what we really are going to pay attention to is what the guidance is going forward from these retailers. And it's going to be interesting to see exactly how much they put on tariffs, how much they believe is due to their own strategies. I don't think we're going to learn that much new, though. I have to be honest with you, because the consumer has held up. You use the word resilient. They have done fine. I think we're going to see Walmart doing fine. We're going to see TJX doing fine this week. We're going to see Target not so much. There are stocks up today, but maybe people think they may do better than expected, but it's still going to be pretty poor compared to Walmart or TJX, for example. I wouldn't put a lot of store. I think Macy's is going to do poorly. I think Gap, is kind of questionable right now. So we kind of know what we're going to see, and the real question's going to be, what do they say about what's going to happen in the future? And that we just don't know what they're going to say. I think it'll be very conservative. They're going to worry a lot out loud, and then they're going to beat it when we get to the third quarter.
The other big wild card is, as you say, tariffs, right? And there has been a lot made of us not seeing the full tariff impact yet. But the way that retail ordering cycles work, isn't that tariff impact coming maybe in the fall?
Well, it may be. I've said for a long time, I've been on record that I think that the impact has been overblown. People have worried about it too much. And I'll point out, we haven't seen it yet. And I understand what everyone's saying. Oh, it's coming, it's coming. The goods that come in for the fall, they're going to be the one that show all the tariffs. But just keep in mind, a lot of the products aren't imported at all and don't have any tariffs on it. So when we talk about these big tariff numbers, that's on the cost of goods, not the retail price, only on the part that's imported, which affects some retailers a lot more than others. For example, affects Target a lot more than Walmart does. And I don't think we're going to see some kind of big explosion here, on the net downside in terms of operating results. We just aren't.
But somebody's going to have to pay the piper, Jerry, right? Even, so maybe it's not a big, broad effect, but there's going to be an effect somewhere, right? Maybe it is Target more, maybe, but, they're not. It has to show up somewhere, one would think, eventually.
But you need to add up how much it is and say how much, is that really a lot in the scheme of the size of U.S. retail sales? And when you take a look at it that way, of course, there's a lot in certain categories that are very import heavy. But across the board, it just isn't, because you have big things like food, almost all of which comes from the U.S. Some imported from Mexico, of course. Some products like bananas or coffee that are uniquely hit, but most products come from right here in the USA. And you have huge retailers like Walmart that just don't import that much. When you take a look at what percentage of their sales it actually is that are heavily affected by tariffs, and then you look at some of these tariffs when they're under 20%. A lot of that does get absorbed throughout the supply chain, where it's just not that noticeable. Keep 20% on the cost of goods, not on the retail price.
Sure.
And so all the rest of that has to come into play there. So I don't think it's going to be as bad as people say. I know everyone wants to think that, but I'm just telling you, I don't believe it, haven't seen it yet, and don't think we're going to see it going forward. The people who are poor already, poor performers, are going to use it as this year's excuse. 2 years ago, maybe it was retail theft or something. And, there's always, sometimes it's the weather. But, I'm not saying it won't affect anybody. Of course, if 100% of a category comes from Vietnam, like Nike's apparel, shoes, for example, they're running shoes, or from China, of course it's going to be affected to some degree, but it's not going to be the kind of market meltdown type event that everyone keeps talking about here.
Consumers turning pessimistic as worries over inflation rise, with consumer sentiment seeing its first decline in 4 months. As uncertainty lingers, we're diving into what this means for consumer staples. Washington Crossing advisors Chad and Morganland are here to discuss. Chad, so first of all, staples, big picture. How are names in this sector generally, Chad? How do you see them navigating the macro and tariffs, those dynamics?
So oddly enough, consumer staples valuations are at a multi-decade low. And you've seen a deceleration of volumes, albeit 1 or 2% lower than what it was like back at the beginning of the year. But we think that many of these companies could navigate the tariff headwind quite nicely. One has to just be mindful that these companies really live and die by what the consumer health is, but they're much more resilient than perhaps some of the big box retailers.
Let's talk about some names, some picks. Why is Pepsi a buy?
Well, it's at a multi-decade low when it comes to valuation. Yes, there's some headwinds when it comes to perhaps the snack food side regarding GLP-1s. It's really hard to quantify that headwind, but the multiple is really attractive. It's growing, it's profitable, it's well capitalized, and it's a rising dividend stock. It's really a steady Eddie.
Do I need to be worried about, Chad, and we were talking off camera about this, RFK Jr., when I had plenty of analysts come on here and tell me, listen, he is not a fan of the salty and the sugary, right? He thinks we're eating too much of this stuff to begin with. How does that play into some of these names as an investor? Do I need to be mindful of that?
Well, you certainly should be mindful if there's any regulatory or government action that will perhaps disrupt the business. We think, though, that that valuation is now priced into the stock. All you really need to see is top-line growth reaccelerate from 1 or 2% to 3 to 5% to really get a strong return, a total return on the mark on that Pepsi stock.
What about GLP-1, that risk? Is it a risk?
It is a risk. It's a risk for all the snack food companies. They will be perhaps with their portfolio modestly shifting their portfolio structure to more protein-centric, similar to what Coca-Cola did. But overall, we think that the valuation makes sense. The companies really took a beating when you went into more of a high volatility trade, high beta trade. They sold down these consumer staples and they bought the more higher beta, higher volatility companies.
Quickly, Procter & Gamble, you also like. How come?
Yeah, grown, profitable, well capitalized, very durable, doesn't have the GLP issue, nor does it have the other overhang when it comes to the political issue. We think that they need to just grow again at 3 to 4% to justify perhaps a 15 to 20% move in the market, in the stock over the next 12, 18, 24 months.
All right, Pepsi and Procter & Gamble, thank you, Chad.
Thank you.
While wrapping up today's Market Domination, don't go anywhere. Got you covered. All the action following the closing bell. Stay tuned for Market Domination Overtime.